What if I told you that the choice between an ISA and a pension could be the difference between financial freedom and leaving thousands of pounds on the table? Both are powerful tax-efficient savings tools, but many people don't understand how to use them properly, or worse, they ignore one completely. So which one is better for you? Should you focus on growing tax-free wealth with an ISA, or securing long-term savings with a pension? Or maybe both? Stick around, because in this video, I'll break it all down. The key differences, when to use each, who benefits the most, and how to maximize your savings for the future. By the end, you'll know exactly where to put your money for maximum growth and tax efficiency. Assalamu alaikum. My name is Abu Fazal. I'm the head of private client services here at Wahed. Our job at Wahed is to help everyday Muslims like you grow your wealth through a range of world-class financial products that are easy to access with low investment minimums, and most importantly, don't compromise your faith or values. We're helping more than 400,000 clients all over the world manage and grow their money in a better, smarter, and more efficient way. ISAs and pensions in the UK are what are known as tax wrappers. A tax wrapper is essentially a financial container that holds your investments and provides certain tax advantages. Think of it like a protective shield, or a sweet wrapper if you will, around your money, helping you keep more of your returns by reducing the amount of tax you pay. In the UK, there are several types of tax wrappers, each with its own rules and benefits, and two of them are ISAs and pensions. Let's start with an ISA, or individual savings accounts. An ISA is a tax-efficient account that allows you to save or invest money without paying tax on the returns. The key benefit? Any income or gains you earn inside an ISA are completely tax-free. Firstly, cash ISAs, a savings account with a tax-free return. Cash account returns tend to be low as there is little risk involved. It can be opened from the age of 16. Secondly, stocks and shares ISAs allows you to invest into stocks, funds, or ETFs. You need to be at least 18 years old. And the main reason somebody invests into this type of account is to take advantage of the growth potential of the stock market. Thirdly, lifetime ISA helps you save for a first home or retirement with a 25% government bonus of up to £1,000. To qualify, you need to be under the age of 40 when you're first setting one up. Can be invested into cash or stocks and shares. Lastly, an innovative finance ISA. This type of account is suitable for somebody who wants to lend money to somebody else for a promise of a fixed rate of return back, with a promise of a capital return at the end of a fixed period of time as well. You need to be at least 18 for this type of product. Each tax year, you can invest up to £20,000 across all of your ISAs, and once the tax year ends, your allowance resets. Now let's talk about pensions. A pension is a long-term savings plan designed specifically for retirement. The government rewards you for contributing by giving you a tax relief, which means you get extra money added to your savings. There are three main types of pensions in the UK. Firstly, state pension. It's paid by the government and it's based on your national insurance contribution history. Secondly, a workplace pension. Your employer sets this up for you and they contribute as long as you're contributing towards it too. Lastly, a personal pension. You decide where your money is invested and who you set it up with. The biggest difference between an ISA and a pension money is locked until the age of 55, rising to 57 from 2028, while ISAs give you complete flexibility to withdraw at any time. Now, let's compare ISAs and pensions side by side. Let's start with the main purpose of each. The purpose of an ISA is for general savings and investing, whereas a pension is really for long-term retirement saving. The UK government gives tax relief on contributions you make to your pension, whereas you receive no tax relief on contributions to your ISA. Withdrawing from an ISA is completely tax-free. In the case of pensions, you're allowed to withdraw up to 25% as a lump sum, completely tax-free. The rest of it, you can choose how much to withdraw, but you'll be taxed at whatever your margin rate of tax is. Workplace pensions also give you the added bonus of receiving employer contributions, which is a huge bonus. However, an ISA allows you to access your funds whenever you'd like, which is one of the major features of this account, whereas the pension is locked away until the age of 55 or 57 from 2028. Finally, the annual allowance of an ISA is just £20,000, whereas the pension can be up to £60,000 or 100% of your earnings, whichever is lower. To summarise, while ISAs give you flexibility, pensions can give you more free money through tax relief and employer contributions. ISAs are ideal if you need access to your money before retirement and prefer flexibility, and you're already optimizing your workplace pension contribution with employer matching and want additional tax-free savings. Pensions are ideal if you're employed and your employer matches your pension contributions. This is free money. You're a high rate taxpayer. While basic rate of tax is claimed within your pension scheme, you can claim the additional amount on your tax return, which effectively reduces your tax bill, so the net cost to you is significantly less. You're okay not having access to your retirement savings, and you're comfortable with locking the money away until later. If you're self-employed, you can make payments from your business into your pension pot. You're essentially moving money from your business into your personal name without triggering a tax bill as a consequence. Now, within a personal pension, you can actually buy commercial real estate. And because any income or gains is tax-free within a pension pot, any income or gains you make from that commercial real estate investment is tax-free as well. So imagine if you're a business owner and you own your own factory or you own your own office that you work out of, you could actually sell that to your pension scheme and pay rent to your pension pot, essentially growing your pension pot, making payments, but also it grows tax-free. Before deciding how much to put into an ISA or a pension, here are some key questions you should ask yourself. 1. What's my retirement income goal? Do I need £20,000 or £50,000 a year? A good way to start thinking about how much you need is as a proportion of what you're earning today. Now, bearing in mind, some costs you incur now, like school fees or housing costs, may be smaller or not applicable later on. 2. How much do I need to save to reach that goal? You can use Wahed's goal setting calculator on our website to help work this out for you. 3. Can I afford to lock money away until the age of 55 or 57? Within a pension scheme, obviously, because of the tax relief that you're getting when you're putting money in, you're restricted as to when you can access it. So maybe thinking about when you want to access or have the ability to access is another consideration to make. Fourthly, am I taking full advantage of my employer's pension contributions as well? Finally, what tax bracket am I in? Obviously, with tax relief on pension contributions and things like that, as a higher rate taxpayer, you can claim additional tax relief on your tax returns, and as an additional rate taxpayer, even more so. These questions are designed to help you to start understanding the type of life you want to have after retirement and set the precedent for the types of actions you should be starting to take now. If you're employed and your workplace pension offers a pension scheme, your first priority should be taking full advantage of those employer contributions. Many employers match pension contributions. So for example, if you're paying in 5%, your employer will match that as well. This is essentially free money and 100% return on your contribution before even considering investment growth. Let's take an example. You earn £40,000 a year, your employer offers you a 5% match, meaning that you contribute £2,000, your employer adds an additional £2,000. Your total pension savings for the year is £4,000. If you ignore this, you're literally leaving free money on the table. Just make sure your workplace pension scheme is Shari'a-compliant. Most providers will offer you a Shari'a-compliant option. Sadly, most of these options are equity only, so it's not really equivalent to what many of your colleagues will benefit from in terms of risk management as they get closer to retirement age. This is why Wahed has partnered with pensions master trust provider Smart Pensions. They've recognised the disparity between Shari'a-compliant and non-Shari'a-compliant schemes, so they asked us to manage the Shari'a-compliant section, which means employers will get fully risk-managed pensions, which manages the risk same way that many non-Shari'a-compliant providers manage their pensions today. Pensions are fantastic for long-term growth, but what's the downside? You can't access your money until the age of at least 55. That's rising to 57 from 2028. That's where an ISA comes in. It offers tax-free growth without locking your money away for decades. This makes an ISA perfect for mid-term financial goals like buying your first home or building wealth while keeping access to your funds if needed. How to balance both? First, you may want to consider contributing towards your workplace pension. Get that free employer matching. Next, invest into a stock and shares ISA to build tax-free wealth which you can access at any time. If you're self-employed, have older pension pots, or you've maxed out your employer contributions, you may want to focus more on an ISA or a personal pension. Which brings us to the next step. If you've got a few old schemes knocking around, or don't have a Shari'a-compliant workplace pension, or just want to take control of your pension savings in a Shari'a-compliant way, a SIP with Wahed might be right for you. A SIP, or a self-invested personal pension, means you choose where your pension is invested, unlike traditional workplace pensions that invest in non-Shari'a-compliant assets like interest-paying bonds or non-permissible industries like arms manufacturers. Now let's take an example. If you wanted a £10,000 investment into your pension scheme, you'd only need to pay in £8,000 yourself. The other £2,000 is actually claimed back by the administrator from the HMRC, and that's added to your £8,000. So now you've got your £10,000 investment. Now, if you're a higher rate taxpayer, you actually claim back another £2,000 on your tax return. This means that you've got a pension worth £10,000, but the effective cost to you has been only £6,000. Your investment strategy should evolve as your life circumstances change. So how do you adjust your contributions as your wealth grows? In your 20s and 30s, you may want to prioritize ISAs for flexibility and start contributing enough to your pension to get your employer matching your contributions. In your 40s and 50s, you might want to start maximizing pension contributions as you earn more and get higher tax relief and more compounding power as a consequence. In your 50s and 60s, you may want to start shifting your focus, start finalizing those pension savings whilst also using your ISAs for easy access to funds. Remember, because of the tax efficiency, pensions are ideally long-term wealth building, whilst ISAs offer you flexibility in the short term. Finding the right balance ensures you're prepared for both financial growth as well as financial security. Let's compare two options, a regular ISA and a SIP, using £8,000 invested annually for 20 years with a 7% average annual return. Firstly, within an ISA, contributions to an ISA are made from your net income. This means that the £8,000 you invest has already been taxed through your salary. Your ISA grows tax-free, and when you withdraw, you don't pay any tax on the gains. £8,000 invested annually for 20 years at a return of 7% per year will result in just under £328,000. You contribute £8,000 each year, but the government adds tax relief to make your total contribution £10,000. Contributions to a SIP are eligible for tax relief. For every £8,000 you contribute, HMRC adds an extra 20% or basic rate tax, making your contribution effectively £10,000. This means you're investing £10,000 each year instead of just £8,000. The SIP grows tax-free, meaning you don't pay tax until you start withdrawing. When you do, you control how much you withdraw, and therefore you control how much tax you pay. Since HMRC adds £2,000 in tax relief, no tax is directly paid on the £8,000 you contribute towards the SIP. Essentially, you're getting the £2,000 back that you would have paid in tax if it were a regular income. With the government's contribution, you're investing £10,000 each year. After 20 years of 7% growth, your SIP could grow to approximately £410,000. In summary, with your ISA of £8,000 a year growing at 7% a year over the next 20 years, resulting in £328,000. With your SIP, with £10,000 growing at 7% a year for over the next 20 years, you result in £410,000. That's more or less a £100,000 gain over your ISA. Unlike an ISA, your SIP contributions are made with pre-tax income, meaning they aren't subject to income tax at the time of investment. Which one should you choose? If you're saving for retirement and want to maximize tax advantages, a pension is a better choice, especially if you can lock away the money until retirement. If you need flexibility and want to access your funds earlier or prefer tax-free withdrawals, an ISA might be a better fit for your needs. ISAs and pensions are both powerful tools, but they serve different purposes. The key is to understand your goals, take advantage of tax benefits, and make informed choices. If you'd like to start investing into a Shari'a-compliant pension or an ISA, click the link below to get started. Thank you for watching. Don't forget to like, share, and subscribe to stay connected and up to date with future videos. Assalamu alaikum.